Hello, everyone, and thank you for joining us. My name is Samantha Johnson, and I am the Assistant Director of Alumni Engagement at the University of Colorado Boulder's Leeds School of Business. Leeds is a top business school offering undergraduate, MBA, MS, and PhD programs, and has an alumni network of over 41,000 strong living and working around the world. We're excited to have Rich Wabakind presenting on the economic outlook for 2018, How Much Wind is in the Sails, for today's webinar. A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask Rich, please send those questions through the chat interface. I will monitor the questions as they are submitted, and Rich will answer them at the end of his presentation. As a reminder, for optimum audio quality, we do have everyone on mute except for myself and our speaker. If you experience any technical difficulties during the webinar, please notify us through the chat interface, and one of our support specialists will touch base. Lastly, a link to access the webinar recording will be sent to all registrants later today, along with a survey link. Now, I'd like to introduce today's speaker. Dr. Richard L. Wabakind is Executive Director of the Business Research Division, Associate Professor of Business Economics and Finance, and Senior Associate Dean for Academic Programs at the Leeds School of Business. Rich teaches MBA students in macroeconomics, public policy, and entrepreneurship. He has received 4 awards for teaching excellence from the students of the Leeds School of Business. Rich has lived in Colorado for 40 years and has spent much of his time studying the development of the Colorado and regional economies. Rich received a BA in economics from Bucknell University and an MA and PhD in economics from the University of Colorado Boulder. Welcome, Rich, and thank you so much for being here.
Well, thank you, Samantha, for having me, and thank you all for joining us to discuss the state of the economy at the national level and at the state level. As many of you know, we do an annual forecast at the Leeds School. We just did our 53rd annual forecast that we released in mid-December, and I'm going to be talking about some of the results from that forecast as well as general opinions about the national economy and the state economy for that matter. So with that little bit of background, let me jump into the national economy. Certainly, we have seen stronger GDP growth over the last few quarters, averaging over 3% for the last 3 quarters, and that appears to be a very solid growth, but also growth that can continue into 2018, especially in light of the recent tax packages and tax cuts that were passed. There should be enough additional momentum in the economy to carry the GDP growth at a 3% rate. This is up, of course, a little bit from 2.5% for sort of over the previous year. So this is stronger growth, and that stronger growth with it is being driven really by 2 areas. If you look at the graphic that's up there now, the left-hand side, personal consumption expenditures, and the bottom quadrant on the left-hand side, the fixed business investment, are the 2 areas that are really carrying the economy. The consumer has been very strong, not just this past year and the year going forward, but the last 5 years or so has really been the cornerstone of the economy. And then recently, in 2017 and now carrying into 2018, fixed business investment from the private sector has also been an important part of GDP growth. Government spending is tepid at best, as you can see in the upper right-hand quadrant of this graphic. And net exports, although closing the gap a little bit, still remain a drag on the economy. We have seen an increase in exports, but we have also seen an increase in imports. So net-net, that really isn't making much of a difference in terms of the overall GDP picture. All of this has led to continued strong growth in employment. As you can see from the graphic, we peaked back in about 2014 period. We've been on a slow decline in terms of monthly growth in employment, but still positive and very much in line with what one would anticipate this far out into the business cycle, and also with the unemployment rate at current levels. We'll talk a little bit more about that in slides that follow, but again, very solid job growth in the 160, 170 range, certainly nothing to cause any levels of concern. So how does Colorado fit into this picture? For quite a few years, Colorado was consistently performing in the top 5 in terms of states, in terms of employment growth, at least in states around the country. More recently, we've fallen to about the 10th position, but still very, very strong job growth. You can see a few of the states not far from here doing quite well: Nevada, Utah, Texas, and then Idaho and Washington with also strong growth. So you really see the growth sort of in the mountain states, and then of course down in the southeastern part of the U.S. Come back and talk a little bit more about that later, but still Colorado in a very solid position. And this strong employment growth over this period of time has brought down unemployment rates to very acceptable levels. I think many people would say full employment levels. 4.1% for the conventional or headline number that we talk about, U3, and even when including underutilized labor, 8.1%. The numbers in Colorado, which you will not see in any detail, are about 1.5 points below in each category, roughly, in both the U6 and the U3. Labor force participation continues to be an issue. We need more people to stay in the workforce, given the low unemployment rate at the national level. And one of the areas of concern, again, continues to be 20 to 24-year-olds and 25 to 34-year-olds. We have lower participation in the younger age categories. We are at the highest level ever for 65 and above, and we are approaching that for the 55 to 64 bracket, as you can see on the right-hand side of the graphic. And I would highlight that even though these are, record-setting sort of levels for 65 and above, the participation rate is still a small fraction of what it is for prime working age population, the 25 to 54 sort of range, the 3 bars, number 2, 3, and 4. So when we look at the overall picture, this paints a picture that shows the ability, if you will, to get a little bit more participation out of younger people in the population, but overall a picture that doesn't show an awful lot of potential when you think about people aging and moving across to the 55 to 64 range and 65 and above, as is occurring with the aging of the baby boomers. So with a background on employment and output, GDP and employment and unemployment rates, let's talk a little bit about the major components of the economy. And leading off, of course, with the largest single component, which is income and consumption, or big C, as we like to refer to consumption. So you can see revised after the recent tax cut, a big jump up in the 2018 real disposable income numbers, the after-tax numbers, and that leads to a strong growth in real personal consumption in the coming year. So the tax cut, we believe, will filter through part of it to increase consumption. The increased consumption, again, will be one of the major drivers of GDP growth in 2018. But it isn't the only thing that's driving consumption in the economy. It's not just income, high employment rates and high income growth. It's also very dependent on wealth. And we can see strong growth in the various categories of wealth, including retirement accounts and other things that are included in the other asset category. So we have very strong increase in wealth, in addition to the income effect that we talked about a little on the previous slide. The combination of those really gives you the ability to consume at a higher level, and we again have seen that reflected in the last several years. When we look at the picture here in a little bit broader context, I would tell you that here we are with the rise in the securities over the past 8-year, 9-year period. And when you look at the particular indices here for NASDAQ and Russell and so on, you can see the dramatic increase particularly in the financial assets part of the wealth effect. We know we've also seen it in housing. We'll talk about that in just a moment, but we've certainly seen it in terms of financial assets. I would say with my astute investing ability, I unfortunately purchased CPI futures that are on the bottom there. And missed out on all of the great things that are on the top half of the graphic. So when we look at housing prices, you can see that across the entire country, they're in positive range. Our neighbors to the north in Wyoming in the 0 to 2% bracket, the lowest appreciation category, but you can see many parts of the country at 6 to 8, 8 to 10, and 10 and above. You can see Colorado has actually gotten out or dropped out of the top grouping, the top 5. We're now roughly number 7 in the country in terms of home price appreciation, but still hovering around 9% year over year. So we've had dramatic home price appreciation. We have increases in the cost of living in the state that are significant, 3.5% in the most recent release for the Denver Boulder CPI. So you see, again, this very strong housing prices driving part of the cost of living issues that we're facing. I'll come back and talk a little bit more about that, and maybe we can talk a little bit more about that in the Q&A if people are interested. So the strong home prices along with the strong asset prices, again, very powerful in terms of the wealth effect and driving consumption in the economy. And if those two things alone weren't powerful enough, we also have a low interest rate environment. Yes, it's up a little bit from what it was, and we believe will continue to be going up throughout the year. But nonetheless, in terms of servicing debt, in a historical context, as you can see on this particular slide, we are at very, very low levels in a long-run context. The percentage of our monthly disposable income that we're using to pay off debt is at extremely low levels. So we have low debt burden. We have a high wealth, high income environment. And all of that leads to a very strong ability to consume on the part of households. But they have to be willing to consume. And this is measured in most traditionally by looking at confidence indexes. And the index of consumer confidence from the Conference Board is one that we particularly use that includes both the United States and also the Rocky Mountain region, which is where Colorado is included in this particular data set. And you can see, again, we're back to and have exceeded pre-recession levels, the 2008 recession particularly. So we're looking at very, very strong consumer confidence, and everybody appears to be feeling great about life at this particular point in time. And all of this translates into, as I suggested, strong consumption growth in the economy. The consumer continues to rule the day in many ways, and this will be reflected in continued strong auto sales, although not at the same levels as the last couple of years, but still strong, and also strong growth in retail sales at the national level. And so we continue to see, once again, strong consumption environment. But importantly, as we forecasted a year ago, businesses have come back into the marketplace in a big way, driven by optimism, but also driven by much stronger corporate profits in 2017. We saw a significant jump up in business fixed investment, and we believe that with the tax cut and continuing strong corporate profits, we will see another strong year of business fixed investment this year. And this is, of course, driving not only short-term GDP growth, but a very important pillar for the long-term growth of the macro economy, as you have more business fixed investment, putting in more productive production capacity, and also enhancing the productivity of the worker. So all of those things turn out to be very, very positive for the larger macro economy. Again, businesses, much like consumers, have to feel good about life, and the most commonly cited indexes for confidence are the ISM series for the manufacturing sector and for the non-manufacturing sector, retail and services and so on. And you can see the manufacturing sector at the highest level it's been in quite some time, hitting high peaks again. services, while not at the early part of the 2000 decade kinds of numbers, again, are also at very, very strong numbers. So business optimism is measured by the ISM quite strong. We also see business optimism as measured by the NFIB, the National Federation of Independent Business, Small Business Confidence Index, if you will, also very, very strong. So business confidence is high, business profitability is high. Again, access to capital, good, and cost of capital still very good in this interest rate environment. All of those things portend a strong investment in business environment in 2018. So a couple of other just sort of quick comments. So consumption, investment, and then government expenditures. And we'll talk a little bit about trade, international trade. So as I suggested, government expenditures directly are not really fueling much of the growth in the GDP. They're using the tax cuts and trying to inspire the consumer and corporations to really be the major sources of growth. But the new tax cuts are leading to wider budget deficits, and projected over a longer period of time by the Congressional Budget Office. You don't see it on this particular graphic. These numbers go back to $1 trillion deficit in a few years out. So this particular tax cut that occurred, while I think received well by many, at least in the economy, certainly was a deficit-financed tax cut. It should have stimulatory effects, but it does do long-term damage to the federal budget in terms of budget balance and the debt that's going to be carried forward. As I mentioned, international trade net hasn't been particularly positive in terms of adding a lot of stimulus to GDP, but what you can see is that during the past roughly year, we've seen a decline in the value of the dollar after having a very, very strong and long run upward. This decline in the value of the dollar has really helped the agricultural sector and the manufacturing sector with exports. We have seen a strong year in manufacturing in 2017, and we think that will continue in 2018. So this has been beneficial, even though, again, it's not a large contributor to the overall more positive outlook that we're presenting for GDP growth. In terms of looking a little bit at the monetary environment, the Federal Reserve, of course, is changing leadership in the next month. Chair Yellen is stepping down, and we have our new chair coming in. And in the process of looking at that, one thing that's sort of in the back of the mind is, will things be different, or will things be very similar or the same? And clearly, we think things will be very similar or the same. The path will be slow, steady growth in terms of interest rate projections, and we're going to see that sort of step upward over time. Our forecast calls for 3 rate increases in 2018. The more recent data that has come in that shows a little bit more inflation in the economy might suggest, as one Fed bank president said this past week, that could even do an additional one. 3 seems almost baked in at this point, but they may go to a 4th increase. I don't think that's the majority view right now, but that's one of the scenarios that's being presented. So we're looking at, again, gradual, slow uptick in interest rates, and rates that still, in historical context, are modest, or even at the low end. They're at the low end now and modest in historical context. And this fits in well with the inflation scenario. You can see, other than shelter, which has been rising at over 3%, the red line on this particular slide, that the regular core items and the core CPI and the regular CPI hovering in the high 1s or 2% range. So very much in the range of what the Fed is desiring, sort of a 2% inflation rate. the problem has been that has been the high end of the range, and they would rather see that as being sort of in the middle of the range, meaning inflation rate that went up to 2.5 and down to say 1.5, hovering around the 2% range. But more recently, and again with the rising oil prices that we've seen in the last month and a half, 2 months, continue to anticipate a little bit of a bump up in terms of the inflation rates. So at the end of the macro session, I'd like to ask Samantha to put out the poll question for, we only have one poll question today, but there's a poll question that I hope you will respond to.
Wonderful. Thanks, Rich. So I'm going to go ahead and launch this poll question now, and you'll see it. So if everyone would like to select their response, the question is, most households should see a lower tax bill in 2018. How do you plan to spend the tax savings? The options are plan to pay off debt, increase savings, pay off medical bills. It looks like we're missing an F there. And then buy something big, or you don't expect a tax cut. So we'll leave it open for a few more seconds here. It looks like we've got about 75% of the votes in. All right, great. And it looks like everyone has voted here. So we'll go ahead and share the results. So Rich, it looks like the top response with 51% was increased savings. And then we've got a tie at 22% for pay off debt, and I don't expect a tax cut. 1% are planning to pay off medical bills, and then 5% are planning to buy something big. So as you know, we also asked this question in our alumni newsletter that was sent last week. And I'd say that this is similar in that increased savings was a high response. But the big difference here is in our newsletter, 49% of respondents felt that they didn't expect a tax cut, as opposed to 22% here on the webinar today. So with that being said, I'll go ahead and hand it back to you, Rich.
So thank you. So it appears that at least the people who are listening to this webinar are going to foil the stimulative fiscal efforts of the government by paying down debt or by putting money into savings. I personally applaud both of those. But not spending the money or not going out for the frivolous purchase, is what I think there's at least some hope that the consumer with this additional money will pay down those, will have more consumption out there and maybe not focus as much as putting money into savings. I have to say the reason that we added the medical tab is I read a poll survey over the weekend that over half the people responded that they were going to use the money they expected from the tax cut to pay off medical debt that they had accrued, which really took me by surprise that there was that level of medical debt still sort of sitting out there on the sidelines. But that just may be part of my naivete about the medical cost situation that we're facing at this point in time. When I look at the overall picture on Colorado, and we have many people from Colorado, but we also have people from around the country that have joined this. So I will talk about Colorado and, again, put it somewhat in a national context in this second part. We continue to be a strong population growth state, but not quite as strong as it's been recently. We've seen a little bit of a tailing off in net migration to the state, and we actually expect these numbers to be revised down a little bit more. So instead of being a top 2 or 3 growth state in terms of population, we fall into sort of the 7-8 slot, depending on percentage or absolute growth, and continue to have a lot of the growth along the Front Range, which you can, again, see the sort of comments I'm making off the slide. So, again, strong population growth, which is, and in migration, which is important given our employment growth that's been going on, but not quite at the pace that it's been. So people aren't moving as much, and we know that other areas of the country are very attractive, but also have very low unemployment rates. So we have competition, if you will, for the migrants coming into Colorado from other parts of the country. When we look at our overall forecast, we continue to forecast a downward trend in new jobs being brought online. This peaked back in 2014. We started to see the effects of the oil price bust, if you will, commodity effects from lower oil prices, and that came into effect and had a pretty big impact in the 14 sort of 15 time frame. And we see the numbers being much more sluggish in 2016 and 2017 than they had been in the prior 3 years. Our continued forecast downward is not because we believe that Colorado is in particularly dire straits at all. We think the economy is doing great. We just don't have a lot of available workforce. So as I suggested, we do the forecast annually. We produce a very elaborate report with discussion of the various sectors of the state economy, and almost every sector reported that they couldn't get enough qualified labor. Not just retail and not just hotels, construction, agriculture, manufacturing, computer programming, cyberspace, aerospace, you name it. People said not enough people, not enough qualified workers. So we see a real constraint coming into play based on slower in-migration to the state and lack of available workforce. Not all parts of the state have benefited equally in terms of looking at the big picture here. We've seen the Front Range really have the most growth, and particularly the Northern Front Range that I affectionately call the Northern Territory for Collins, Loveland, and Greeley have been on very strong growth spurts. The Greeley area is, again, most Coloradans know, but for the people who are not local at this point, very strong growth based on oil and gas. That, of course, took the dip when we saw the commodity prices slow down in 15 into 16, but now we have seen that come back up as well. Strong jobs also in that area in construction, and a very strong agricultural base in Weld County as well. For Collins and Loveland, great universities up in that area, Northern Colorado and Colorado State, but also very strong high tech, and we've seen a very positive entrepreneurial environment. So for those who haven't been in the state recently, we've started to see significant expansion away from just the core metro area, north to Fort Collins, Loveland, and south, all the way down to strong growth to Colorado Springs and growth all the way down to Pueblo. So the Front Range has really densified a lot and spread out a lot, and that's part of the infrastructure investments that'll be going on in the state over the next few years, is really attempting to handle that extended growth that we've seen. Importantly, you can see the national economy down there in sort of the orangey red line, 3 from the bottom, and virtually every area of the state has exceeded the national economy growth other than Pueblo and Grand Junction. Grand Junction starting to get a little bit of traction, but again, impacted by the commodity prices, particularly natural gas, and haven't really seen a recovery in that particular industry. So their growth is really based on diversification of their particular economy. When we look at our statewide forecast, again, as I was suggesting, it's not that we think the state's doing poorly in any way, shape, or form. In fact, we're forecasting employment growth in every sector of the state economy. The issue here, again, is limited workforce. And so the limited workforce gives us a job forecast below what would be the case if we had, say, 4 or 5% unemployment in the state. And although you see a very skinny line for mining and logging up at the top there, which is the natural resources piece of the employment picture, that's in fact the highest percentage growth of any of the sectors. So we do think there is a recovery going on in the minerals part of the state. I'm going to talk a little bit more about that in a moment. but that's part of what we see going on in the overall picture. And again, these labels may not all be easily understood by people who don't follow the employment data, but the professional and business services down in the bottom left-hand corner with the largest number of jobs includes a lot of people who would have graduated from the business school, accounting and marketing, and all of those types of professional business services, and includes a lot of the R&D and the high-tech space. It includes architects and legal. So it's a very important sector, and a lot of job growth in that area is very important for the state. When we look around the state again, going back to those employment and unemployment numbers, sort of reflective of what you saw in the earlier graphic. So the state is running at 2.9% unemployment, up just slightly over the last couple of months. It got as low as 2.4%. These are record-setting levels of unemployment for the state, the lowest that they've been. So we have extremely low unemployment. And you can see even in areas that have above average unemployment, the number is still a very modest number. Grand Junction under 4% at the bottom of the graphic, as well as Pueblo a little over 4%. You look at Pueblo and say, oh, poor Pueblo, it's actually their lowest unemployment rate since 2000. So all areas of the state appear to have a very tight workforce as reflected by the unemployment rate. When we look at one of the big issues here, and it's not just in Colorado, but we hear a lot about this nationally, is wage growth. And this is leading to all sorts of concern about median incomes and more divergence in terms of wealth and lack of wealth in the economy. And one thing you frequently hear referenced is that the average wage is not growing very rapidly. And there are a few reasons for that, but I thought I would take a moment to talk about that specifically in the context of Colorado and what we see in the Colorado data. If you look at the all industries, the tan band, if you will, in the middle, you can see that the tan band in the middle, gives us the average, if you will, for the state in terms of the average wage, the average employment growth, and so on. Anything above that particular tan band is an above average wage industry, and the ones below are below average wage industries. So you can see in our particular case in Colorado that if you look at the upper right-hand corner, the year-over-year wage growth for the top two high-wage industries was negative, and in particular, management of companies and enterprises was largely negative. Well, that's a gobbledygook title that most people would not know, but that is a reflection of corporate headquarters. And during the year, we had during the past 2 years, we've had several corporate headquarters leave the state, and corporate headquarters tend to have extremely high-paying jobs. So we've taken a bit of a hit due to loss of these extremely high-paying jobs. Also, you would see that the higher growth rates, highlighted in green, many of them are below the line, meaning that jobs are growing more rapidly in below average wage categories. So we see things like healthcare and social assistance with a 4% job growth rate, below average wage, educational services, below average wage, accommodation and food services, below average wage. So when you look at the picture, you see that we're generating more low-wage jobs. The numbers we've done more recently, where we don't need the detail of data that's on this particular slide, indicate that about 2/3 of the jobs in the state are being generated in below average wage categories. So this is a contributing factor, again, to average wages not rising at a very rapid rate. A third piece, which is commonly discussed nationally, not just in Colorado, is that we are replacing older workers or more senior workers who are retiring, baby boom retirees, with younger workers coming into the workforce. And the younger workers coming into the workforce are extremely talented and well educated. That there are no issues there, but you're replacing a 55-year-old with a 25-year-old, and in the process, or a 60-year-old with a 25-year-old, you're going to have a differing wage for the 25-year-old and than the exiting 60-year-old who's been in the industry for 30 years. So in that process, we're replacing higher wage workers, if you will, with lower wage workers, even though we're talking about people with very similar skill sets, less experience, but very similar skill sets. So all of those things we believe are contributing factors, and the data seems to support that in terms of why average wages aren't rising more. And this is particularly an issue in Colorado when we talk about the issue of the rising costs of housing and the overall CPI being higher in Colorado than the national increase. Your wages rising at a reasonable clip are very important. One of the reasons I believe the citizens the legislature really pushed for, and the citizens voted for, a higher minimum wage, which we passed a few years ago, and as of January, our minimum wage went up to I want to say $10.20 an hour, but it just had a increase on January 1st. So we have some, government instituted, if you will, response to wage appreciation or wages not growing rapidly enough. We can talk more about that in the Q&A if people are interested when we get to the end of the presentation. So some quick slides. I always like to show this one in the front range because people don't know what these animals look like. So this is what these lovely animals look like. We're looking at gross farm income. Again, it's very important in the state, and all of this is highlighting is that due to low commodity prices, particularly corn, hay, wheat, we are seeing overall net farm income has been down the last couple of years. We do expect a little bit of a bounce back in 2018, but we are still talking about a commodity cycle, if you will, in the agricultural sector. Why this is important in the overall picture of Colorado is that Colorado has areas of the state that are extremely dependent on agriculture and don't have a lot of diversity in terms of their economic base. They don't have a lot of different industries. So when we go through agricultural cycles and when we go through, frankly, mineral cycles or natural resource cycles, we have those areas of the state go through, booms and busts, if you will. So with that background, let me just then move for a moment to the natural resources and mining area, the minerals area, and talk about that for a little bit. And I think this graphic highlights this sort of movement through the cycle. When you when you look at the run up in oil prices in 2014, and then you see the drop in oil prices, you can sort of see the amount of difference in the dollar value of output. The oil value, by the way, is reflected in the black bar at the bottom, the black part of the bar. So you can see it as sort of rise up in the black, and then what has happened more recently. But if you go all the way back to 2008 and my comments about Grand Junction, look at the price and look at the value of natural gas in 2008, which is reflected in the green piece of the bar, and then what the size of the green piece is in 2009. So when you look at those particular changes in output, you look at that and say, well, was that half the output? No, that's a dramatically lower price on very similar levels of output. And when that happens, you start to see cuts in severance taxes and other sorts of fiscal resources that many of these communities depend on. Changes property tax values, it changes severance tax take, and so on. So the areas that have these natural resources and depend on the natural resource economy tend to have real booms and busts to their cycle. One interesting change that has occurred fairly rapidly in the state over the last decade and will continue to change fairly rapidly in the next 8 years or so is the movement to renewables. we suggest one of the most ambitious renewable energy portfolio projects in the country, including wind, solar, and hydro. 21.5% of all of our generation in 2016, and we are a strong state for both wind and for solar. And Xcel Energy, the largest utility in the state, has put in for additional wind projects out on the Eastern Plains, continue to develop and grow the renewable base, come out with new goals just in the last day for 2026. So we're looking at a continued movement in that direction, and all of that causes, change, disruption, and other things that we can talk about in terms of traditional fossil fuels. The construction industry is an important piece of the state economy and also reflective of the growth that we have seen, the population growth that we've seen. And during the past 20, 30 years that you can see on this graphic, the red line is reflecting how many additional housing units we built and how many additional housing units we built, and then the gray, the tan is reflecting the need, if you will. So this is sort of a look at supply and demand, and when the tan is higher than the red, we've underproduced housing, and when the red is higher than the tan, we've overproduced housing. So we had this tremendous overproduction of housing after the 2001 economic bust, the technology bust in the state, and we had years of overproduction, and now we're looking at particular period now where we have significant underproduction, and this is one of the many things that has led to rapid house price appreciation in Colorado, which I'll discuss with you in just a short moment. When we look at these prices, these average prices, I'm going to move a little bit more rapidly because I do want to save a few minutes for Q&A at the end. You can see the average rents had gone up at very rapid rates in 2014 and 2015. They've come down to more single-digit kinds of levels, but you can see since 2010 how rapidly the tan line is going up and the cost of renting in the state has gone up. And again, reflective of higher housing costs and very much reflective of the cost of buying housing is raising the cost of renting housing, rental housing, et cetera. So this is for the last year, statewide 9.3% year-over-year housing price appreciation. And on the right-hand side, we've averaged 4% annually for compounded annual growth rate in housing prices statewide. Typically, according to real estate economists, this number should be closer to the inflation rate in the state. Housing kind of moves in with the price of inflation on average. So we're moving well above the price of inflation over the past decade. And again, that's made Colorado housing substantially more expensive. All of that has sent a signal to the housing sector, build more, and you can see we are building more, but we're not building as much as we built back in the 1996 to, say, 2005 period. We are going to be at the highest level we've been since the 2005 period. So we're getting back to building more housing, a combination, again, of both single-family and multifamily. And overall, the construction industry will be at its highest level in terms of total building, a combination of residential being higher, but also growth in non-residential and in non-building. A lot of infrastructure projects I alluded to earlier, particularly I-25 North and I-25 South out of Denver will be getting a lot of investment, construction investment. Big in construction investments in DIA, as we have seen large growth in air flights at DIA. So we are starting to see just a lot of infrastructure investments to try to keep up with the population growth that we have experienced over the past 15 years. Colorado public land visits, because I know a lot of people love the state even if they don't live here, and we're attracted to the state for the great outdoors. Public land visits are up. Skier visits were up last year. We'll see. The snow has been difficult this year, you probably heard. And this slide reflective again, 2017, you can see how dramatic the increase in the passengers have been at DIA in both 2016 and 2017. We're forecasting similar increase for 2018. A lot more direct flights, and continues to be a major U.S. hub, seventh busiest airport in the U.S., but like the third busiest for interconnecting for U.S. to U.S. based flights. So very, very strong sort of connecting hub, which has really helped in terms of business attraction, I might add. Retail sales, 4.5, 4.6, so a solid number, and again, very important for state retail sales tax, but also for local governments. We can talk more about that later. And then government finance, very strong, and again, probably better known to people in the state than out of the state. The revision of the federal tax code is going to give a windfall flow of money to the Colorado General Fund. The federal tax policy change at the individual level was to widen the base and lower the rate. So you saw lower tax rates across most brackets at the national level. Well, in terms of the state taxation, there is going to be this bigger base, but there's not going to be a lower tax rate. So there's going to be sort of a windfall of additional money going to the Colorado General Fund, and we're going to leave it to the legislators to prudently figure out which of the projects that are on their list are going to be most important to apply those extra dollars. As we close to the end, I wanted to just show you two slides at the end of this presentation. One gives you Colorado's rankings compared to all other states, and this would go to 51, including District of Columbia. And the lower the number, the higher the ranking. So you can see in many categories, Colorado is very strong, has a very high ranking. Population growth, personal income growth, but there are a couple of warning signs. If you look in that first column, the one column, you can see real per capita income at 43%, even though the growth is at 43%, even though the per capita income itself is at 14. So we're 14th highest per capita income, but our per capita income growth hasn't been strong. And then you look a little further down, our average annual pay, 10, that sounds great, but the average annual pay growth, 35%. 35th rank. So when you look at those two pieces, you see not as much appreciation in per capita income and not as much appreciation in annual pay growth as you would anticipate in a state that has a 2.9% unemployment rate. And again, I guess I would say reflective of the slide I showed you, that the state of Colorado, that 2/3 of the jobs have been generated in below average wage areas. So it sort of gives you a picture. By the way, the very bottom line, the lower the number, not necessarily the better. So we're 6th highest in the past year. Over a 3-year period, we have the most rapidly appreciating home prices. Over a 10-year period, we have the 2nd highest appreciating home prices. So we've had a very, very strong run. And again, that's had a little bit of effect on affordability. Moving ahead, these are some of the headwinds that we are paying attention to. Certainly interest rates and interest rate movements. When will they potentially, slow the economy down? Global growth. We're very pleased with global growth right now, and hopefully that will continue at the pace it's at. Commodity prices are always a concern. Higher oil prices now help with productivity, but also, of course, take away in terms of consumer spending. But we have very low commodity prices on the ag side, so that's something we pay a lot of attention to. the value of the dollar, which had gone through a depreciation over the past year, starting to tick upward a little bit. What will the international trade be like? Drought and weather, we put these things together before we've gone through the current sort of dry period that we've had in terms of snow and winter weather. We're in La Nina. Typically, La Nina has not been good to tourism and has not been good to agriculture, so we're a little concerned there, just in terms of historical context and what we've seen so far this winter. And then policy. We have at least two areas of policy that are still under discussion that could have significant impact on Colorado. The renegotiation of trade agreements, particularly NAFTA. 4 of our top 10 exports in the state are agricultural products. We do a lot of exporting north and south with NAFTA agreements. We're also looking very closely at the change in immigration policy, whatever that may be, in terms of the ability of firms to find employees. Agriculture this year reported not having enough immigrants or free labor force to actually harvest. They left crops rotting on the vine. So we are concerned about those two policy pieces, particularly how they get handled and what the outcome is. Not that they're being addressed, but how they're going to be addressed, so we have some certainty as we look forward. We do see an environment that is extremely positive, and of course it's reflected in the stock market nationally. It's reflected in consumer confidence. It's reflected in business confidence nationally and in Colorado. But we also see a tremendous amount of uncertainty reflected on the part of consumers and households, and a part of businesses, like they want certainty in their decision making. So that's an open-ended piece. So this particular line refers to our website, colorado.edu. At the very bottom of this is where you can access the booklet and access a lot of the other information. You'll also get a link to this sent out by the alumni office after the broadcast, so you can access our information. But I'd like to stop at this point and let Samantha come forward with a couple of questions while we still have a few minutes left.
Great. Thanks, Rich. This information has all been awesome. And then also, as a reminder to everyone on the webinar, you can send those questions through the chat interface in our last few minutes of the webinar here. So question for you, Rich. Similar to the poll that was taken today, it seems like many polls show that consumers aren't planning to increase consumption. So given that, and then the increased deficit, what is your view of the new tax plan over the long term?
Put me on the spot, why don't you? So let me start with the following. The previous administration was also in favor of corporate tax reform. And I think if you look at corporate tax reform in a global context, regardless of how you feel about whether a business is paying, quote, its fair share within the U.S. and the way we think about it, when you talk about global competitiveness, tax rates do make a difference, and the U.S. tax structure on the corporate side was no longer competitive. So I think the corporate side of the tax cut was definitely needed, was proposed really by both sides originally, and is something that will create more investment in the U.S., hopefully more wages. We'll see how the companies actually use the money, but some very, very positive pieces as we go forward. When we're talking about the personal income tax, and let me give you this precursor, or I speak for myself, not for the University of Colorado, not for the Regents, not for anybody else. I think they had to do the personal tax cut because the masses would have been so upset if there was a corporate tax cut and not a personal tax cut. But I am a deficit debt hawk. I follow very closely the work of Committee for Responsible Federal Budget, and we are on a very, in my opinion, bad course in terms of accumulated debt at this point. And I don't think the personal tax cuts were necessary or needed. And if they were, they should have been frankly, more directed at the middle class. So personally, and again, I'm giving you my opinion on this, I don't like that particular piece of the tax policy, and I'm not entirely surprised that people are saying they're going to save the money or they're going to pay down debt. Good for them, and I'm happy for them. But I would rather see the long-term debt not get continually passed on down the line. I don't need to go into a demographics lecture, but a tremendous number of people are retiring on a daily basis. These people are getting paid, receiving a lot of payments from Social Security and Medicare and so on, and this is a big drain on the federal government's budget, and I don't see anything that we've done that's really addressing that over the long haul.
Thanks, Rich. Another question for you on the national level. Do you expect workforce participation for the group that is ages 65 plus to increase, decrease, or stay relatively stable within the near future in the next 5 to 10 years?
So we have seen that workforce group go up each year, 15, 16, 17. I do expect it to continue to increase. It's just such a small number compared to people who are in their small percentage compared to people who are in their prime working years. But people are healthier, they're living longer, and a lot of people want to stay active, work active, not just physically active, but work active. So I think you're going to see that bracket continue to edge up a little bit, and that has helped the national participation rates, which had fallen dramatically, have leveled off and even slightly ticked upward. So we are seeing a little bit of that impact, but that group alone is not going to be enough to offset what's happening in the low age brackets.
Great, thanks, Rich. And we have time for a couple more questions here. So one other question, this is specific to Colorado, but I think this could be applied nationally. So you were showing some of the changes in salaries, in average salaries. How do you see this affecting the increase of cost of living? How are folks planning to pay for their bills, pay for rent, et cetera, with what we see is either flatline or decrease of average salary, but increase of cost of living?
Well, it can be applied nationally, but I think it is a particular concern for Colorado. I think with the housing costs and so on, that when we have people not getting wage increases that keep up with the cost of living, you have, if you looked over the last 5 years, the average Coloradan has lost purchasing power. And here we have an incredibly prosperous state generating tremendous job growth, top 5 job growth nationally, and the average person is really not any better off in terms of the amount they're making compared to the cost of living. So I think that is something that has to change, and it particularly is problematic in the lower wage ranges in terms of people being able to afford rental housing and so on. But I didn't dwell too much on this, but the bottom wage categories were the ones that had the highest wage appreciation as well. So that was sort of good news in the grand scheme of things, even though they're the lowest wage areas, they had the highest percentage growth. And they were exceeding the cost of living in terms of the annual increases. It's really the higher wage categories that haven't kept up.
Thank you. And we have time for one more question here. We're just about at top of the hour. So the question here is, Rich, do you have any comments on investor outlook for this next year?
Well, I have sort of 2 comments because I am an investor, so I kind of think of it that way. And part of me is worried everybody's rushing in. If you're following what has gone on in the financial markets over the last few weeks, tremendous inflows to almost any type of financial investment. And I kind of understand why that is. I mean, it's a very positive forecast for the national economy and the global economy. And we haven't had that at the same time in a long time, that the global economy was growing and really helping the U.S. economy in terms of, spreading global growth. So all of that says to me, sure, we should be in there. Then the flip side of it tells me, if you look at valuations and some other things, this is a market that seems to be a little frothy. So I have reservations. I am, can we continue to maintain this kind of, price growth? Are we going to have some sort of correction? I would expect a correction. But overall, if you think it's linked to profitability of firms and corporate tax rates and all of those things, I could see at least the first half, 3/4 of the year as being quite positive. Maybe second half of the year or the last quarter with some corrections in mind.
That's so interesting. Thank you, Rich. And thank you so much to everyone for joining us for today's presentation. And Rich, again, thank you for sharing all of this great information with us. To view upcoming webinars and request previous recordings, please visit our website at www.colorado.edu/alumni/webinars and have a great rest of your day, and go Buffs.